For centuries, gold has been the undisputed king of safe haven assets. When things get shaky, that's where people run. But what if its reign is coming to an end? We're about to dive into a really powerful idea from investor Lawrence Lepard, who thinks a massive wave of capital is about to shift from the old world to the new. And yeah, you guessed it, Bitcoin is sitting right there, ready to catch it.
So, what's causing this huge potential shift? Well, it all kicks off with one single, massive problem that seasoned investors are watching like a hawk. It's a phenomenon that Lawrence Lepard and a few others have a name for: the big print.
The idea is actually brutally simple. Governments are drowning in debt, right? And the easiest, quietest way to deal with it is just to create more money out of thin air. Now, Lepard argues this isn't some temporary fix. It's the new normal, a permanent cycle. This big print just eats away at the value of currencies like the dollar, which means the cash in your bank account is constantly losing its buying power. And that forces investors to find shelter and fast.
Historically, when our money is under threat like this, capital always flows into physical, tangible things, assets that governments can't just print into existence. This has been the playbook for generations, pushing investors toward those classic safe havens.
And of course, the traditional choices are gold and silver. Think of gold as the big, stable anchor. It's the first thing to react to global risk and fears about inflation. It's the foundation. Silver, on the other hand, is like gold on steroids. One source even calls it gold with an accelerant, which is perfect because it follows the exact same signals as gold, but with way more volatility. That means bigger swings, both up and down. But we're in a digital age now, and a totally new solution was born directly out of that last big financial crisis back in 2008. An asset that was literally designed from the ground up to solve the exact problems of government-controlled money. People love to call Bitcoin digital gold because, yeah, it shares gold's best features, like scarcity and being a store of value that no single country controls. But honestly, that comparison almost doesn't do Bitcoin justice. Because when you actually look at the essential qualities of what makes good money, it surpasses its physical cousin in pretty much every single way that matters.
Just look at this breakdown of the digital advantage. Gold. It's heavy, it's hard to move, it's a pain to divide into small amounts, and verifying it is a whole cumbersome process. Bitcoin, though, it's incredibly portable. You can send $1 billion across the globe in minutes for a few bucks. It's super easy to divide down to the tiniest fractions, and it's instantly verifiable by a global network that nobody controls. It is, in a lot of ways, what the economist Friedrich Hayek dreamed of, a type of money that governments simply can't stop.
So, if Bitcoin is superior digital gold, it should act like a safe haven, right? When things get scary, its price should go up. Well, this is where the story gets a little complicated. The market recently saw something that seemed to totally break that whole narrative.
This is the million-dollar question that had analysts just scratching their heads. As a recent year came to a close, fears of inflation and economic troubles sent gold and silver prices soaring. In fact, gold had its strongest year since 1979. But Bitcoin? Its price actually fell, and pretty sharply. This split really led a lot of people to wonder, wait, did Bitcoin just fail its biggest test as a hedge against uncertainty?
Okay, but this is exactly where Lawrence Lepard's thesis comes in, and it offers a really compelling counter-argument. He basically suggests that if you're just looking at this short-term split, you're completely misreading a much deeper, more powerful market dynamic that's at play.
Lepard's argument is that gold and Bitcoin are absolutely correlated, but there's a critical time lag. Gold, with its thousands of years of history, acts as the primary signal. It's the first asset to sniff out major shifts in the economy. You could say it's the ultimate canary in the coal mine for the entire financial system.
So, if you look at it through this lens, gold's powerful rally isn't a sign that Bitcoin is weak. It's the exact opposite. It's a massive flashing warning flare for the whole market, signaling that something really big is just over the horizon.
And what is gold reacting to? It's that big print we talked about at the beginning.
Its price surge is the market's first gut reaction to the inevitable wave of inflation and currency destruction that's coming. Gold is simply the first responder on the scene.
Okay, so if gold is the first mover, the big signal, then what comes next? Well, the thesis predicts a massive rotational flow of capital. The exact same fear that drove investors into gold is about to start looking for its next and even more powerful destination.
And this quote from Lepard just captures the idea perfectly. His message to Bitcoin investors is basically, don't get frustrated that gold is running ahead of you. Be happy about it. That rally is the signal that a huge wave of capital is building up, and, as he puts it, it's about to come to you.
So what does this coming wave even look like in terms of actual numbers? I mean, the price targets Lepard is talking about, they aren't just small gains. They are absolutely monumental, reflecting a complete repricing of what sound money is worth in a world of endless printing.
And he's not mincing words here. He sees gold going to $10,000 an ounce, but that's just the prelude. He predicts Bitcoin will eventually hit $1 million per coin. Now, I know these numbers sound astronomical, but they're based on the sheer scale of the monetary disaster he sees coming down the pipe.
Okay, we have covered a lot of ground here, right? From the problem of the big print to that confusing split between gold and Bitcoin, and finally to this thesis that ties it all together. Let's just boil it all down to the essential takeaways for you.
So here's the entire argument in 3 simple steps. Number 1, the core problem is the big print. Our money is being systematically devalued. 2, gold is the signal. Its recent surge is the market's early warning flare that a huge shift is happening. And 3, this is Bitcoin's moment. As the superior form of sound money, it's perfectly positioned to catch that wave of capital and probably amplify it. The question really isn't if investors are going to seek shelter anymore, but where that tidal wave of capital is going to land next.
It's a really powerful thesis, one that suggests the entire financial landscape is on the verge of a historic, once-in-a-generation shift. And understanding these signals is absolutely crucial for navigating whatever comes next.
Look, the old financial system is under enormous pressure, and a new one is being built right now, in real time. Here at Crypto Explorer 24/7, we are dedicated to tracking these monumental shifts. So to stay ahead of the curve with us, make sure you subscribe for more deep dives into the future of money. Thanks for watching.
Welcome to Crypto Explorer 24/7. So the market forecast for 2026 is looking, well, a little weird. We're seeing this massive split where physical stuff like metals could be about to skyrocket, while something we all use every day, gas, is set to get way cheaper. Now, this isn't just a story for Wall Street. This huge divergence has some pretty major ripple effects for crypto. Let's get into it.
And this slide right here tells the whole story in a nutshell. On one side, you've got the heavy hitters forecasting gold to hit an absolutely wild $5,000 an ounce. And on the other, the national average for gas is predicted to drop to around $3 a gallon, a low we haven't seen in years. So how can 2 pillars of the economy be sprinting in opposite directions? And more importantly, what does that mean for the crypto space?
Okay, first up, let's talk about the massive bull case for metals. And look, we're not just talking about a little price bump here. A lot of the big analysts are calling this a potential supercycle, and it's being driven by some really powerful fundamental shifts in the global economy.
I mean, just look at this number. The confidence behind it is incredible. We're talking a $5,000 price target for gold from giants like JP Morgan and Goldman Sachs. And it's not just the big institutions either. A recent survey shows that 71% of everyday retail investors also see gold hitting this mark by 2026. That is a seriously widespread belief.
And if you think the outlook for gold is strong, you got to see what they're saying about silver. It's even more dramatic. JP Morgan is targeting $58, but some analysts are talking about a potential push all the way to $100. Why? Well, silver's got this dual identity. It's an investment, for sure, but it's also a critical industrial metal for things like solar panels and EVs. And that industrial demand is creating a massive supply crunch.
When you've got copper, which people often call Dr. Copper because it's so good at diagnosing the health of the economy,
After a mind-blowing 60% rally in 2025, analysts are still forecasting another 35% jump in 2026. The demand is just relentless, and it's coming straight from the biggest growth sectors in the world.
So what's driving all this? It's not just one thing. It's a perfect storm of powerful forces. You've got expected Fed rate cuts that could weaken the dollar, which is almost always good for commodities. You have these deep-seated supply deficits that you can't just fix overnight. Central banks are buying up gold like crazy, and holding it all up is this huge industrial demand from AI, electric vehicles, and green energy, all while investors are looking for a safe place to park their money. This quote from FX Empire really nails it. The rally we're seeing, especially in something like silver, isn't just being dismissed as a short-term speculative bubble. Experts see it as a fundamental repricing based on a real structural change in global supply and demand. It feels like the rules of the game are actually changing.
Okay, so while the metals world is shooting for the stars, a completely different movie is playing out with energy. Over at the gas pump, things are going in the total opposite direction. For most of us, the cost of filling up your tank is actually about to get a whole lot cheaper.
The headline here is a projected national average gas price of about $3 a gallon for 2026, according to the U.S. Energy Information Administration. That would be the lowest annual average price we've seen in 4 years, taking us all the way back to 2020. That's a big deal.
You can see the whole trend right here in black and white. And look at that top line. That's the key. The price of Brent crude oil, which is the global benchmark, is expected to fall off a cliff from $81 a barrel down to just $55 in 2026. That huge drop flows directly to what we pay at the pump for both gasoline and diesel.
So, what's behind this drop? Well, number one is obviously cheaper crude oil. But there are a couple of other things going on. First, cars are just getting better mileage, and the slow but steady adoption of EVs is starting to put a ceiling on gasoline demand. But, and this is a big but, there's a catch. Even as crude oil gets cheaper, the refineries are expected to take bigger profit margins, basically soaking up some of those savings before they ever get to you.
And here is a super important detail. This trend of falling gas prices is not going to be the same for everybody. While most of the U.S. is probably going to enjoy prices under $3, California and the West Coast are actually expected to see prices rise to an average of $4.10. So what gives? It's all about major refinery closures out west, creating a local supply shortage, which basically cuts that region off from the cheaper prices everyone else is seeing.
So we have this incredible split, right? Hard assets are soaring while energy costs are falling. This brings us to the big question. How does this battle between old-school commodities connect to the new world of crypto? Well, the connections are actually way more direct than you might think.
Let's start with the most obvious link. As gold, the OG store of value, blasts off towards $5,000, does that make the whole argument for Bitcoin as digital gold even stronger?
You know, when you put them side by side, the parallels are pretty striking. Gold is the world's tried and true safe haven asset. Bitcoin is now seen by many as a digital hedge against those very same risks. While central banks are stacking up gold bars, huge institutions are allocating capital to Bitcoin as their digital store of value. So yeah, a rising tide for gold can absolutely make that digital gold story a lot more believable for a lot more people.
But the connection goes way deeper than just that. Let's go back to copper's rally. It's not just about building houses. It's being driven by the insane build-out of AI data centers and green energy grids. This is a direct signal of massive investment into the physical hardware, the servers, the wires, all of it, that the entire digital economy, including tons of crypto and DePIN projects, absolutely needs to function.
And on the flip side of all this, you've got falling energy prices. For proof-of-work networks like Bitcoin, electricity is the single biggest expense for miners. It's not even close. So cheaper energy across the country translates directly into lower costs for miners. This can boost their profits, which encourages more miners to join and secure the network, ultimately making it stronger and more decentralized. It's a huge win.
Okay, we've covered a ton of ground here. So, let's just boil this all down into a few clear, simple takeaways for your 2026 market cheat sheet.
First, the case for metals supercycle is very real. There are strong fundamental reasons to expect gold, silver, and copper to keep performing well. Second, for most people, energy costs are probably coming down, which is great news, but you have to keep an eye on those regional exceptions. And third, all of these old-school market trends have a direct impact on crypto by making narratives like digital gold stronger and by changing the basic economics of mining.
And this really brings us to the ultimate question for 2026, doesn't it? In a market that is so clearly split, where is the smart money going to go? Is it going to rush into the tangible, physical safety of old-world metals, or will it double down on the digital, decentralized assets of the new world?
The answer to that question could really define this next era of finance. For more explainers breaking down how the traditional and crypto worlds are connected, make sure you're subscribed to Crypto Explorer 24/7. Thanks for tuning in.
So right now in 2025, the market's telling us three totally different stories. One's about an ancient metal that's in a serious physical crisis. Another is about a digital fortress that's facing a brand new kind of threat. And the third, well, it's about the quiet, behind-the-scenes construction of a new financial world. This is the tale of silver, Bitcoin, and Ethereum, and what their very different paths are telling us about the future. Okay, so let's just dive right into the big puzzle here. For years, you've heard the pitch, right? Bitcoin is digital gold, a hard asset that's supposed to act like precious metals. But in 2025, that whole story is starting to crack. We're seeing physical metals absolutely take off, while Bitcoin is just stalling. So what gives? Why is one of these hard assets just flying, while the other is completely stuck in the mud? What's really going on? All right, to really get what's going on, we're going to follow three different paths. First, we'll get our hands dirty and dig into the raw physical squeeze happening with silver. Then, we're going to pivot to the digital world and try to decode this pretty serious threat that's looming over Bitcoin. And finally, we'll check out how Ethereum is quietly becoming the plumbing for the future of finance. Okay, first up, silver. Its recent explosive move isn't just about hype or a bunch of traders jumping on a trend. No, this is a story about a physical crisis that's been brewing just under the surface of a highly leveraged and kind of fragile paper market. The real issue here is just old-school supply and demand. I mean, just look at these numbers. The gap is absolutely massive. Bitcoin is actually down, yet silver has exploded by 143% this year. Gold isn't too far behind either. This isn't just a small difference. It's a fundamental break in that all hard assets move together story we've been told. So what on earth is fueling this frenzy for physical metal? And the answer, well, it starts with this one number, 5. For 5 consecutive years, the world has used more silver than it has mined and produced. This isn't a one-off thing. It's a chronic, structural deficit that has been getting tighter and tighter year after year. And we're not talking about a small gap here. This deficit is huge. In 2025 alone, the world is on track to be short over 230 million ounces. That is the physical reality that's propping up this entire rally. There just isn't enough of the actual metal being produced to meet demand. And this is where things get really crazy. This is the market's biggest weak spot. For every single ounce of physical silver that's actually available for somebody to take delivery of, there are 356 ounces of paper claims, things like futures contracts, betting on it. It's like a giant house of cards. As long as everyone's happy just trading the paper, it's fine. But if enough people show up and say, I want the real thing, the whole system could be in big trouble. So you see the picture, right? It's a tale of two completely different worlds. On one side, you've got this wild, speculative paper market where prices get tossed around by traders. But underneath all of that, there's a very real, very undeniable physical supply crisis. And in the long run, physical reality, it always wins. It's basically a perfect storm. You've got all these different forces coming together at once. Industrial demand is just surging thanks to solar panels, EVs, and the whole AI boom. Then you've got a major supplier, China, making noise about restricting exports. And all of this is happening at a time when the physical stockpiles and warehouses are already at rock-bottom levels. All right, so that's silver's story, a real-world physical problem. Now let's completely switch gears and talk about Bitcoin, because its challenge isn't physical at all. It's a high-stakes tech drama playing out in the digital world, a threat that calls its fundamental security into question. So the big boogeyman here is something called a just-in-time quantum attack, or JIT for short. For the longest time, everyone thought, hey, as long as I don't reuse my Bitcoin addresses, I'm safe from future quantum computers. Well, this JIT attack kind of throws that out the window. It lets an attacker snatch your funds while they're in transit, basically hijacking your transaction before it ever gets confirmed.
And look, this isn't some sci-fi movie stuff that's decades away. Researchers have calculated that a pretty modest quantum computer could crack a standard Bitcoin key in about 66 seconds. That's way, way less than the 10 minutes it takes to confirm a block. So imagine this. You send a transaction, an attacker sees it, cracks your key, and reroutes the money to their wallet, all before your original transaction has a chance to go through. Terrifying, right?
So how do you fix this? Well, the solution is, frankly, a monster of a task. It's like having to move the contents of every single safe in the world to a new, stronger type of safe, all at once. The network would have to process all of these upgrade transactions, but they'd have to get in line with every normal payment, creating this massive digital traffic jam on the blockchain. And here's the kicker. Here's the number that really tells the story. Even in a fantasy best-case scenario where the entire network stops everything else and dedicates 100% of its power to the upgrade, it would still take a bare minimum of 76 days of total network downtime to get it done. It is a massive technological hurdle, and it's casting a really long shadow over Bitcoin right now. Okay, so for our third and final story, let's talk about Ethereum. Because while silver is dealing with physical limits and Bitcoin is getting ready for a huge defensive battle, Ethereum is playing a totally different game. It's not really about being a store of value. It's about becoming the foundational layer, the new rails for the traditional financial system. You've got three huge forces pushing this forward. First, we're finally starting to get some regulatory clarity, and that's giving big institutions the green light they needed. That, in turn, has led to huge amounts of money pouring into new Ethereum ETFs. And, maybe the most important piece, we're seeing an absolute explosion in the tokenization of real-world assets, or RWAs. And this isn't just talk or some far-off prediction. It's literally happening as we speak. The value of real-world stuff, think stocks, bonds, even real estate, that's been put on the Ethereum blockchain has almost tripled just in 2025. And the big institutions, they are overwhelmingly picking Ethereum as the place to build this new infrastructure. I mean, the potential scale here is just mind-blowing. You have major global banks like Standard Chartered putting out reports projecting that markets for things like stablecoins and these tokenized assets on Ethereum could hit trillions of dollars each within just a few years. This really frames Ethereum less as a competitor to gold and more like a foundational piece of technology, like the internet itself. Okay, so let's pull all three of these threads together. What does it all mean? Well, what we're seeing is a major shift, a great divergence. The market is finally growing up. It's no longer just treating all these different assets like one big blob that goes up and down together. It's finally starting to tell them apart. This table really just lays it all out, plain and simple. Just look at what drives them. For gold and silver, it's about real-world stuff. Safety from geopolitical risks, central banks buying it up, actual industrial demand. For Bitcoin, it's still mostly treated like a high-risk tech stock. When big money buys gold, it's usually a flight to safety. When they buy Bitcoin, it's usually to chase momentum. Those are two completely different behaviors. So here's the most important takeaway from all of this. The era of all crypto moves together is pretty much over. The simple narratives are done. Assets are now being judged on their own unique strengths, their own specific risks, and their own real-world uses. Silver's use is physical. Bitcoin's is secure decentralization, which is now being tested. And Ethereum's is becoming the programmable infrastructure for finance. Understanding these separate paths is the only way to make sense of this space now. And all this leaves us with a huge question as we look to the future. As these different assets continue to go their separate ways, which story is going to win out? Is it going to be the timeless value of a physical hard asset? The high-tech race to build an unhackable, quantum-proof network? Or the quiet, steady construction of the rails for a whole new financial system? The truth is, nobody knows for sure.